Inflation is a fundamental concept of economics that has existed for thousands of years, which helps one understand the markets. Inflation is the rise in prices or the decline of purchasing power over time. But how does it work? How does it affect economies? And what does it mean for the finance world and the world in general? The rise in prices, which is often expressed as a percentage, means that one unit of currency buys fewer goods and services. The consensus view among economists is that sustained inflation occurs when a nation's money supply growth outpaces economic growth. A simple example of historic high inflation is of the Spanish conquest of the Aztec and Inca empires. After the conquest, massive amounts of gold, and especially silver, flowed into the Spanish and other European economies. The money supply rapidly increased. The more money, the less it has value, contributing to rapidly rising prices. Supply and demand affects the value of money just as it does physical goods. Inflation affects different industries, products, and services differently. For example, the average price of a cup of coffee drastically changed over time. Inflation is generally caused by there being more supply of money than demand of products, which usually happens in one of three ways. The government legally devaluing the currency by printing more money. People loaning new money into existence through the banking system by purchasing government bonds from banks on the secondary market. Or economic collapse and the decline of goods and services. There are also some other causes in the other types of inflation. Inflation is classified into three types. Demand pull inflation, which is the upward pressure on prices that follows a shortage in supply, where too much money is chasing too few goods. Cost push inflation, when a supply shortage happens due to a natural disaster, an increase in labor prices, or supply chain problems, companies typically respond by increasing their prices to cover higher production costs. And built-in inflation, which occurs when workers expect their salaries or wages to increase, when prices of goods and services increase to help maintain their living costs. Businesses, workers, and consumers must all account for the effects of generally rising prices in their buying, selling, and planning decisions. This introduces an additional source of uncertainty into the economy. Inflation also distorts relative prices, wages, and rates of return along the way. Inflation can be viewed positively or negatively, depending on the individual viewpoint and rates of change. Higher inflation harms savers because it erodes the purchasing power of the money they have saved. Those with tangible assets, like property or stocked commodities, may like to see some inflation, as that raises the value of their assets. Too much or too little inflation are both considered harmful. Very low inflation usually signals demand for goods and services is lower than it should be, and this tends to slow economic growth and depress wages. Many economists advocate for a middle ground of low to moderate inflation of around 2% per year, although it varies on the country. Stockholders benefit from a maintained, good level of inflation, around 2 to 3.5%. This is because businesses are able to grow, as well as the economy at a sustained and healthy level. When the US dollar goes above 3.5%, the New York markets may go in a recession, and holding dollars instead of stocks would be better. The most commonly used inflation index is the CPI, the Consumer Price Index, a weighted average of prices of a basket of goods and services such as transportation, food, medical care, which are primary consumer needs. You can use yearly and monthly CPI rates to understand the state of countries' economies and stabilities, and help you make financial decisions in the markets in the long run. 2022 saw 40-year high CPI numbers due to the Russian invasion of Ukraine and sanctions causing a deprivation of energy for many countries. Many economists now believe we are due a recession in the stock market, and the crypto market has seen its toll and might continue further. Understand the world situation, the markets you invest in, and what the economy brings for the businesses. Inflation sparks the increase and growth of stocks and assets, and that is why you should invest. As with the necessary continuation of inflation, different assets are bound to increase in not only price, but value. Don't forget to like and subscribe. With us, you can learn and master investing, business, and finance just by watching our videos. The opportunity is right here. Take it and you'll see your life change.